Guys, China's economy is slowing down and it could very well affect our country. Check this out.
Investors worry that an economic slowdown in China could cut into U.S. corporate profits. Caterpillar shares got hammered after it didn't raise its 2018 earnings forecast on worries about the world's second largest economy. Reporting later this week, Wynn Resorts, Visa, and Ford, all three rely on China for growth. Earnings from chip makers are coming up too, including Texas Instruments and Intel. Both make more than a fifth of their sales in China. But the list of U.S. companies exposed to the country is much longer.
You have to make sure to watch this video today because before long, we may see a mainstream media blackout about this. I mean, just look at what's happening in China. China bans negative economic commentary, mentions of deflation. Now, the last time that China threatened its analysts and reporters about being bearish on the economy and at odds with the government's bullish statements was way back in early 2016 when China had offered or had suffered through a historic devaluation and capital flight, which drained over $1 trillion in Chinese reserves, and when fears that failing to stop money from flowing out of their economy could lead to a full-scale economic collapse. Journalists are calling it stepping up censorship, all supposedly to create a climate dubbed positive energy. But basically, they're doing everything that they can to quell concerns about the country's economic prospects as it experiences a prolonged slowdown in growth, and that also stemmed from what earlier this year was a flood of money leaving the country. In short, Beijing realized that it was of critical importance to preserve confidence in the economy, no matter how fake, and it resorted to the ultimate step indicating that a collapse was nigh. And well, now China's doing it all over again. Along with the recent catastrophic Chinese trade data, which even Treasury Secretary Janet Yellen warned about, this stepped up censorship, just as they call it, and it confirms just how close to the edge China once again is. Chinese authorities are again putting the pressure on, which is a polite way of saying barring prominent local economists to avoid discussing negative trends such as deflation as concerns mount about Beijing's ability to boost a flagging recovery in the world's second biggest economy. Now, according to this report, a lot of local brokerage analysts and researchers at the leading universities, as well as state-run think tanks, they're saying that they had been instructed, literally instructed by regulators, their employers, and even domestic media outlets to avoid speaking negatively about topics ranging from fears of capital flight to softening prices. They counted 7 pretty well-regarded economists that said that their employers told them that some topics were off-limit for public discussion. Even the China Securities and Regulatory Commission, the stock regulator, has accused brokerage analysts of playing up risks facing the economy, which is suffering from weak consumer demand, declining exports, and ailing property sector. The same thing from think tank scholars and brokerage economists, all of whom serve as government advisors. So basically, they're saying that there was pressure to present economic news positively to increase public confidence, and that the regulator doesn't want to hear negative comments about the economy in public, interpreting bad news from a positive light. And so basically, you got an economic slowdown that would pretty much worry any country, coupled with a China that always likes to put on a brave face to the world and a leadership that is particularly image conscious. Now, if you put all three of those factors together, it's pretty much a recipe for a very non-transparent economy, and the real honest to goodness numbers reveal why they're taking this approach. Gross domestic product expanded just 0.8% in the second quarter against the previous 3 months. Last month, the Communist Party's Politburo admitted that the recovery was making torturous progress. So now, while they're trying to restore the faith with limited stimulus measures, certain subjects are taboo, such as deflation. Now, pay attention, guys, because China's and the US economy are more intertwined than some people even think. A lot of American companies actually have huge mega factories in China. Take Tesla for one. And of course, there's Apple too. Two very big names that will be hit by the slowdown in the Chinese economy. China's producer price index declined for 8 straight months since October. Meanwhile, annual consumer inflation hit a 2-year low of 0 growth in June. Citigroup economists, they're saying core goods prices, which pretty much strip out volatile food and energy costs, they had already entered a deflationary zone, thanks to weak consumer demand. But what do their officials say? Deflation does not and will not exist in China. And what makes it even more awkward is that Western economists expect that China will report that it is officially in deflation when it reveals that its CPI for the month of July dropped negative after printing at 0.0% last month, the lowest level in over 2 years. Although we're talking about China, odds are CPI will come in just barely positive and all shall be well. Or else we're about to see a whole lot of imprisoned Chinese economists analysts, and strategists. But seriously, guys, doesn't this kind of sound like lines that we're hearing from our own government officials? You guys remember the official Fed line back then about inflation being transitory, right? And what about when they said that we weren't in a recession even though we had already seen 2 consecutive quarters of negative GDP, which is the technical definition of a recession, right? Kind of feels like the US government and mainstream media are both taking a page out of the Chinese playbook, wouldn't you say? And honestly, I don't think we even have to go that far. Just recently, my wife and I, we went through an outdoor shopping area that used to be bustling back in the day, pretty busy, but we couldn't help but notice how people were acting there. A lot were disassociated with the reality of a beautiful day, the lake, and family. I would almost say like 95% of people eating outside, sitting on benches, bicycles, driving, everything in groups, couples or alone, they were all pretty much locked onto their cell phones. Nobody was talking to one another, just kind of weird. Everyone just stooped down, all wearing the same look. You guys know what I'm talking about? Anyway, I sure hope that does not happen to our financial freedom fam. Guys, keep your eyes on the prize. And hey, don't forget to like this video and subscribe to the channel. Your support definitely helps us get through those YouTube algorithms and get the word out to more people. I appreciate y'all. Like I said, all this China mess could end up spilling over to the good old US of A. Treasury Secretary Janet Yellen said so herself. Specifically, she mentioned her concern about some spillover of the China economy slowdown to the United States. Of course, she didn't forget the company line. She ended by saying that she's still confident about the economy as a whole, but still we've got to read between the lines here, right? She even mentioned the slowdown in US growth. The Treasury chief's comments follow President Biden's remarks that China's economy is a ticking time bomb given its growth and demographic issues. He also talked about bad folks having problems and doing bad things. Go figure, right? China's post-pandemic rebound has fizzled, and now Beijing is faced with deflation, declining trade and foreign investment, a very shaky housing market, and an aging population. As experts point out, before the pandemic, China was growing at about 6%, and now it's struggling to recover. The main components of GDP on the demand side, you got consumption, investment, net exports, they all have very serious problems right now. And even if mainstream media here in the United States is saying that everything's all good, I've personally heard from a lot of people, even some of you guys, that this is not the case. I have a client who, along with her husband, refinanced their home when the rates were low. They refinanced it into a 15-year loan because they were both making great money. Well, he has since been laid off, unfortunately. So he's 55 years old and he's struggling to find a job comparable in pay to what he used to have. He's been unemployed for like 8 months now. She, the wife, she's been pretty much working around the clock just trying to keep them afloat. But I think that they may end up losing their home. Very heartbreaking times for a lot of people, I think. And now China, the world's second largest economy, it's undergoing a growth slowdown that could have a potential overhang on the US economy. And there are US economies that have the most exposure to Chinese markets and consumers, including Apple, Tesla, Starbucks, Wynn Resorts, LV Sands, and MGM Resorts. Now, this analysis is coming from experts themselves. Now, apparently in the last 20 years, they've never seen this kind of weakness where it feels like you have a real confidence issue where the consumer is starting to get extremely nervous, worried about the future, and even holding back. Basically, they're saying that it's a confidence issue and it's very severe, and it's certainly going to have spillovers into the stock markets around the world. Tesla, Apple, very different companies, but still ones that rely very heavily on the spending propensity from consumers in China, as they all have growth ambitions, whether technologically in Apple's kind of handset or smartphone realm, and trying to make sure that they're taking on even more market share, or even in the highly competitive automotive landscape where Tesla has continued to build up its ambitious for both manufacturing and selling in China. Now, you got Wynn, Las Vegas Sands, MGM Resorts, all of these companies have some type of experience that they have either built out in China, in Macau, or tried to cozy up with potential gaming society or gamblers that are placing their wagers in one way or another. So if you're not spending on physical goods, maybe you're spending into services, but are you wagering your money? And that is a big question, and some investors would say no. In fact, heck no. The outlook for a number of those casino operators that have very heavy exposure to China, and also some of those retailers that do a lot of business in China, certainly headwinds, at least in the short term there for those companies. Right here at home, Target is now giving employees an option to get paid daily versus every 2 weeks. Now, I've never seen this before in my life. Economists say that there's a 50% chance of recession in the next 12 months, down from 56% in July and 61% in May. Other forecasters say that optimists mistakenly believe persistently sunny weather means a storm isn't eventually coming. In other words, the Fed's aggressive rate increases will take a bigger toll. It could take a year or two before the higher borrowing costs work their way into the economy. Consumer and business spending may still be chugging along, but they'll be forced to peter out at some point. So they're expecting to see a bigger impact by next year, with a scale back in both consumer and business spending and a rise in layoffs. If you guys made it this far in this video, drop a quick like for the video. Also consider subscribing to the channel, and I'm gonna see you guys on the next one.